Good afternoon, and thank you all for being with us today. I'm Marc Bongiorno, my partner Frank. We are your hosts today, and we are so excited for you to join us. And thank you so much for taking the next 30 minutes or so to spend with us. This information is so important, and it couldn't have come at a better time. And we're all experiencing some really challenging times. I mean, everybody has stories, everybody is going through the same things. And if we can learn a little bit about planning for next year, hopefully it's going to be a better year for all of us. And that's really the goal and the objective for this presentation. We are in the middle of a lot of interesting craziness, for lack of a better term. But I'm sure this information will be informative and very helpful. There will be a Q&A at the end. I ask that you hold all your questions to the end, and we'll try to get to as many as we can. We appreciate so much that you guys joining us. I'm going to try to make it as fun as possible and not bore the heck out of you. All right, so without further ado, let us begin the 2020 presentation on proactive tax planning. Welcome everyone to our proactive year-end tax planning ideas for 2020 workshop. You know, one of our main goals as comprehensive financial professionals is to help our clients recognize tax reduction opportunities both within their investment portfolios and in their overall financial planning strategies. Staying current on the ever-changing tax environment is a key component to help our clients benefit from potential tax reduction strategies. The objective of this workshop is to share strategies that could be effective if considered and implemented before year end. Please note that this workshop is not a substitute for using a tax professional. In addition, many states do not follow the same rules and computations as the federal income tax rules. Make sure you check with your tax preparer to see what tax rates and rules apply in each state. Our main theme for this workshop is that a proactive approach to your tax planning instead of a reactive approach could produce better results. Today's agenda is straightforward. We will review year-end tax planning. While doing so, we will discuss some tax planning ideas and strategies you can consider. We believe in educating our clients on their choices. Our goal today is to give an overview of tax planning so that when you look at your situation, you have some strong foundational information. Please remember, each taxpayer situation should be looked at individually. The good news is we are available to talk with you about the specifics of your situation. Before I get to the presentation, I would like to take a minute to remind you to stay healthy because your health is our highest priority. There's no question about that. We are all still experiencing challenging and unprecedented times. And as we like to share, your first wealth is health. I find it is always important to review that there are 5 key areas of financial planning. They are preservation planning, retirement planning, tax planning, estate planning, and investment planning. These professions, as you know, should all be taken into consideration together and holistically. If you think about how they all relate to each other, there needs to be a synergy. Today's presentation is about tax planning, which can also affect estate planning. As a comprehensive wealth management firm, we try to always consider the impact of any recommendation we make on not just one, but all these areas for our clients. Tax planning for 2020 became a little more complicated because of the Secure Act, which signed into law in December of 2019. Now, this was discussed with many of you earlier in the year and during our reviews because it's so important. And also the 2020 CARES Act added some new laws and rules for taxpayers. Also, with this being a presidential election year, it is helpful to consider some of the tax proposals that are being discussed so that you can plan in an informed way. I'm going to talk about those in a few minutes. Let's start quickly distinguishing the difference between tax planning and tax preparation. Big difference. Tax planning is looking ahead before year end, whereas tax preparation is filling out your tax forms after the year end. Think about it. When December 31st comes, the chapter is closed. Nothing we can do about 2019, so now is the time to plan. This workshop is about tax planning, not tax preparation. It is about hearing some proactive ideas that you can consider now to potentially reduce your taxes. One of our founding fathers, Benjamin Franklin, is credited with saying, "By failing to prepare, you are preparing to fail." For 2020, there are still 7 tax rates. They are 10%, 12, 22, 24, 32, 35, and 37. Under the current law, this 7-rate structure, which was created by the Tax Cuts and Jobs Act, is scheduled to automatically phase out on January 1st, 2026. So all these tax law changes that we've enjoyed over the last couple of years are under the sunset clause is set to phase out. So again, tax planning is very, very important to the planning process. Here are the current tax rates for married filed jointly and single filers. Married filed jointly have lower rates on many accounts, many amounts. For planning purposes, something you need to remember is that even if no changes are made to the tax rates, in 2026, the law says we go back to the older, higher rates. Tax brackets are important, and the current tax laws call for a sunset clause in 2026, which means we go back to the older, higher rates automatically in 2026. When thinking about your plan, please remember this. If there's a change in administration, this could be a whole different ballgame altogether. As this arrow shows, for some people, that means income that would be taxed at 24% today would be taxed in 2026 at 33%, which is a much higher rate. For 2020, the standard deduction amounts are as follows. For individual, it's $12,400. Married couples filing jointly and surviving spouses, $24,800. Married couples filing separately, it's almost like filing single, is $12,400, and head of household is $18,650. So again, unless you have itemized deductions that are greater than these numbers, you will not be itemizing for 2020. And we have to take a look at that because again, many things have changed in the last few years and will change again. So how should you view itemized deductions if you do not take the standard deduction? Well, the old rule was to accelerate or realize deductions and take them as soon as possible. With the higher standard deductions, the new rule is to time or plan deductions. It's all about planning again. Okay, maybe it doesn't make sense to make a charitable donation this year. Maybe make it next year and double up. Maybe in anticipation of the tax law changes under the new administration, maybe it makes sense to sell a position this year. All these things have to be taken into consideration. It's all about the plan. It's all about taxes. Two of the more widespread deductions that taxpayers look at if they choose to itemize and not use the standard deduction are mortgage interest and state and local taxes known as SALT. Under the new rules for mortgages taken out after October 13th, 1987 and before December 16th, 2017, mortgage interest is fully deductible up to the first $1 million of mortgage debt. That threshold has been lowered to the first 750, 375 if married files separately. You see what happens when you file separately. A lot of times you're penalized. So a lot of people try to do this, and they come to realize that it's not what it's cracked up to be. On homes purchased after December 15, 2017. For those of you with mortgages, please check with your tax preparer for how much of the deductions you can take. The Jobs Act also limited state and local income taxes and real and personal property taxes under the SALT to a maximum deduction of $10,000. A lot of us, especially living in New York, in New Jersey, Connecticut, a lot of us understand what that's all about, because you're capped at $10,000 regardless of how much real estate taxes you paid and income taxes to the state. Okay, a lot of people got hurt by this. So it's all about planning. Qualified charitable distributions are a strategy for retirement savers. For people who are inclined to give money away or give assets away, this is important, because as part of the Secure Act, required minimum distributions, just so you know, has been extended now to age 72. Remember the old rule, instead of age 70 and a half, it now is extended to age 72. So that allows, it gives you another year and a half for distribution purposes. Also allows, the CARE Act allowed you to skip or not take your required minimum distribution in 2020. We've had these conversations during tax season with many of you. Some decided to take it, some decided to suspend the distribution. Okay, this is again only for 2020 because of the CARES Act, because of COVID. Qualified charitable distributions are a tax law provision that allows retirement savers over the age of 70 and a half to directly distribute up to $100,000 to eligible charities straight from their retirement accounts and not pay tax on this distribution. So if you're going to give a distribution, and you usually do that with after-tax dollars, why not do it with your before tax dollars or your IRA distributions, especially if you don't need the money? If you're going to give it away anyway, there's a way to be proactive and also reduce tax. One idea that experts suggest is, if you are charitably inclined, consider using part of or all of your required distribution for a qualified charitable distribution, just like I said. Could be very, very effective. Like many of the strategies we are discussing today, this is one you should see us about if you are interested in evaluating your situation. Okay, as you know, we conduct many reviews during the year. Okay, it's all about the review process, all about strategizing, and all about coming up with the best ideas and concepts to keep your taxes under control. Really what it's all about. In 2020, long-term care capital gains still receive a tax break. Here are the three tax rates: 0%, 15%, and 20% for long-term capital gains. Again, depending on your income levels, you can see the top of each capital gains bracket, how the income increases. Once you go into a certain income bracket, you can go from 15% capital gains to 20%. That could be changing as well. One planning item that many taxpayers think about is tax gains and loss harvesting. You know, we see many, many times people come to us and they have their investments done in different places, different broker dealers. And without naming any of these institutions, we feel it's so important that whoever's handling your finance, to make sure that that person understands taxes, understands the tax laws, and knows how to file a tax return, because they could cause you to pay more tax and unnecessary tax than you should, in effect. So tax loss harvesting and gains is a very interesting strategy. We want to get into more detail in a few seconds. Harvesting capital losses is a strategy that has taxpayers selling assets that are at a loss to help offset capital gains. Think about that. This reduces or eliminates tax on current capital gains. On the surface, loss harvesting produces an economic benefit equal to the tax saved. However, sometimes it could only provide a timing benefit. This is a tax deferral strategy that could be very valuable. You got to think about that. Capital losses are highly tax effective if they can be used to offset income taxed at a higher rate. A key fact to remember is you can use up to $3,000 in capital loss above capital gains to offset ordinary income. Also, as a warning, watch out for the wash sale rule. This rule prevents taxpayers from repurchasing a substantially similar security within 30 days of selling at a loss. You got to be careful with things like this. Again, if your broker does not understand tax law, they could be putting you in harm's way because the IRS doesn't like things like this. And we all know we don't want to deal with a cranky IRS. It could become a problem. And that's what we try to avoid here. So if you have any questions on loss or gain harvesting, give us a call and we'll be happy to sit down with you. This is what we do. Capital gains harvesting means taking capital gains in the current tax year. On the surface, it might appear that taxpayers should always harvest gains because of favorable rates. However, harvesting gains introduces a trade-off between lower tax rates versus the loss of tax deferral. You got to kind of put it on a scale. Remember, when taking a gain for tax purposes, although the tax is paid at a lower rate, it's paid sooner. So again, you got to weigh out the pros and the cons, and the only way to do that is to run a projection. And Frank and I do this on a regular basis. Before a client makes a move, they should consult us, whether they're selling their house, buying a house, selling an investment property, buying a stock or a mutual fund, taking distributions out of qualified plans. Let's do the math first. Okay, it's a simple review. Remember, it's always easier to avoid a problem than it is to solve one. Okay, extremely important. In a few minutes, we are going to talk about some of the tax policy proposals, but this is timely. So let's look at one of the former Vice President Joe Biden's tax proposals that is about capital gains rates. The proposal is to eliminate the preferential rate for long-term capital gains and qualified dividends on income over $1 million. This is a significant proposal and a fundamental shift because capital gains rates have never been eliminated for any taxpayers. This proposal is for those affected, basically an increase from 20% to a 39.6% rate. If it looks like it could be enacted, then at today's lower rates, some people could sell their assets. What does that mean? Well, if we anticipate, not that we can predict anything, but again, it's all about planning in advance, strategizing. We have a feeling that tax rates can change for the worse, and maybe it makes sense to sell positions and realize that capital gain today and pay a lower rate as opposed to dealing with the increasing tax brackets down the road. Something to think about. And again, once December 31st comes, the chapter is closed. All right? So I want you to think about that, real important. Let's look at how this works. The old 2017 rules had 3 rates for long-term capital gains and qualified dividends. 2020 still has 3 rates for long-term capital gains and qualified dividends. 2022 could bring 4 rates for long-term cap gains and qualified dividends. Therefore, we need to continue to follow the tax law changes and proposals. We will keep on top of this for you. Remember, folks, we don't want you to worry about things that you don't have to worry about. Okay, that's our job. If we can help avoid these issues, we're going to do our best. Okay, that's what we're here for. Remember to review your year-end retirement contribution planning. Things have changed. Here are some contribution plan maximums that could be applicable if you are participating in one of these plans. IRA or Roth contributions limits are now increased 2020 to $6,000, $7,000 under the catch-up provision. So you add another $1,000 for the catch-up. Same thing with IRAs and Roths. Take a look at 401k plan deferral. Very interesting. $19,500 if you're under 50, Under the catch-up provision, if you're over 50 years old, it's an extra $6,500, giving you a total of $26,000 of elective deferrals in your 401k plan. Think about how powerful that can be when you retire. Think of how powerful that can be right now, because that's $26,000 that you don't have to pay taxes on right now. Okay, it's all about tax deferral. Very, very important, and so on and so forth for employer SEP IRAs and so forth. Okay, so consult us if you have any questions on this. That would be our pleasure to help again. Another critical area to review before year end because of the Secure Act is what we refer to as overall family tax management. Logically speaking, if you are in a higher tax bracket than your beneficiaries, then it might make sense to let them take distributions after your death in their tax bracket rather than yours. Conversely, however, if your beneficiaries are in a higher tax bracket, then it might make sense to take distributions in your tax bracket before death, and then to convert these accounts to Roth IRAs and leave your beneficiaries an account that still must be taken out over the 10-year period under the CARES Act, actually under the Secure Act, but can grow tax-free. We're actually doing this for one of our clients as we speak. Very, very powerful. An annual step to consider is to review your marginal tax rate and your beneficiary's marginal tax rate each year. Remember, it is virtually impossible for anyone to try to advise you on converting an IRA to a Roth without learning how to prepare a tax return, understanding the tax laws, and know your tax situation personally. That's like a doctor trying to write you a prescription without looking at your medical chart, right? Your tax return is your medical chart. So think about how powerful that is, the connection, the synergy between taxes and investments. You cannot pull those concepts apart. It just doesn't work. We've seen this time and time again in our long career of how important that tax document is to the overall investment and estate planning process, especially with these tax laws changing so often. Some benefits from Roth IRA conversions include they can lower your overall taxable income long term. Roth IRAs enjoy tax-free compounding. Roth IRAs have no RMDs at age 72, right? Because the taxes haven't been paid already. Roth IRAs allow tax-free withdrawals for beneficiaries. Okay, so it can help with taxes when at the end of our lives, again, passing on as much of our legacy as possible without the IRS becoming one of your beneficiaries. Okay, that we do not want. We all pay enough taxes, folks. Let's not have our savings tax as well. Qualified tuition plans, also named 529 plans, are a great way to tax efficiently plan the financial burden of paying tuition for children or grandchildren. I will tell you a personal story. My son is 17 and he's looking for colleges right now. And since he was born, and my daughter as well, she's 15, she is a sophomore. I've set up 529 plans since the day that they were born. Okay, and it was the best financial strategy that I've ever done for myself because all of the growth, especially in the last couple of years, has all been tax deferred, and if used for educational expenses, it's all tax free. Think about how powerful that is. Okay, so there have been changes made under the Secure Act. So earnings in 529 plan originally could be withdrawn tax free only when used for qualified higher education at colleges, universities, vocational schools, other post-secondary schools. However, since the changes, that's so now 529 plans can also be used to pay for tuition at an elementary or secondary public, private, or religious school up to $10,000 per year. So high school, grammar school, so forth. Unlike IRAs, there are no annual contribution limits for 529 plans. Instead, there are maximum aggregate limits, which vary by plan. Under federal law, 529 plan balances cannot exceed the expected cost of a beneficiary's qualified higher education expenses. 529 plan limits vary by state, ranging from $235,000 to $529,000. Some states even offer a state tax credit or deduction up to a certain amount. Contributions to a 529 plan are considered completed gifts for federal tax purposes. So in 2020, up to $15,000 per donor per beneficiary qualifies for the annual gift tax exclusion. Excess contributions above $15,000 must be reported on IRS Form 709, gift tax return. It will count against the taxpayer's lifetime estate and gift tax exemption, which is currently at $11.5 million in 2020. Do you remember when the gift tax exemption was $500,000 not too long ago? Now it's $11.58 million. Remember, under the Tax Cuts and Jobs Act for 2018, this is set to expire in 2026. And if there's a new administration, they're looking to propose a $3.5 million estate gift exclusion. So we'll talk about that in a few minutes. There's also an option to make a larger tax-free 529 contribution if the contribution is treated, if it were spread over a period of 5 years. For example, a $75,000 lump sum contribution to a 529 plan can be applied as though it were $15,000 per year, as long as no other gifts are made to the same beneficiary over the next 5 years. Grandparents sometimes use this 5-year gift tax averaging as an estate planning strategy. Think about how powerful that could be. If you want to explore using or setting up a 529 plan, because it could be confusing, we understand that, please don't hesitate to contact us, and we'd love to go over this at your next meeting. Let's talk about annual gifting now. You may gift up to $15,000 tax-free to each donee in 2020. These annual exclusion gifts do not reduce your lifetime gift tax exemption. This annual exclusion gift is doubled to $30,000 per donee for gifts made by married couples. So you can also help someone with medical or educational expenses without incurring gift taxes. There are opportunities to give unlimited tax-free gifts when you pay the provider of the services directly. The medical expenses must meet the definition of deductible medical expenses. Qualified education expenses are tuition, books, fees. We get this question all the time, and related expenses, but not room and board. You can find the detailed qualifications in the IRS publications 950. A wealth transfer planning item to think about is an exemption amounts for gift, estate, and generation skipping tax for 2020. Right now, it's $11.5 million, $23.16 million for married couples. Also keep in mind, folks, that each state has their own state estate tax. So you have to be aware of that. Every state is different. Any amount over that is subject to 40% on the dollar. So back in the day, when the state the exclusion was $500,000, think of how much sophisticated estate planning we had to do with our attorneys to help protect the estate, right? Because if you had an estate over and above $1 million, and how quick can you get there by just adding your house, your investment portfolio? A lot of things had to be done then. Now that exclusion is $23 million for a married couple, but that is subject to change. As a reminder, as of now, in 2026, the estate tax exclusion will return to $5.49 million, which is $5 million adjusted for inflation. On November 26, 2019, the Treasury Department and the Internal Revenue Service issued final regulations confirming that individuals who take advantage of the increased gift tax exclusion or portability amounts in effect from 2018 to 2025 will not be adversely impacted by the Jobs Act and the Sunset Clause of 2026. If you have a large estate, please give us a call because it's all about preservation of wealth, wealth transfer, leaving your legacy And again, not having the IRS become one of your family members. We see it all the time. While the election is in November, Democratic Party nominee Joe Biden has released some possible tax law changes he would like to make if he wins presidency. While these would be future changes and must be approved by Congress, to help you think about planning your future strategies, here are some of the proposed changes to be aware of. Increased corporate tax rates from 21% to 28%. Small business owners, look out. Increase the marginal tax rate back up from 37 to 39.6%. Raise the capital gains tax on filers with incomes over and above $1 million to 39.6%. When was the last time you've seen that? Limit itemized deductions. This is a big one, folks. The Biden's tax plan includes a cap on itemized deductions of 28%. This means for each dollar of itemized tax deductions, including charitable contributions, a taxpayer or a couple filing joint would only receive a maximum benefit of 28 cents, even if a filer is paying a higher marginal tax rate. Imagine that. Phase out small business income deductions for those earning over 400,000. Eliminate step-up basis. This is probably one of the biggest proposals, and we all know people who bought their houses for 50,000 and sell them for $1 million, especially here in Queens. We have so many clients that have been in this situation. It's a good thing, but this could be a bad thing. A step-up in basis refers to the cost basis of assets or property transferable to an heir upon death. If, as an example, an individual purchased a home for $300,000, but it was worth $600,000 at the time of death, today their heir would pay capital gains on anything over and above the $600,000 because their cost basis was stepped up to $600,000. If the home were ever sold, right? So if Biden's tax proposal were to become law, then heirs would not inherit a step-up cost basis. So think about the client, that person whose parent bought the house for $50,000 in Whitestone, and they turn around and that house is worth $1 million. And now that person passes away, their family members would have to pay capital gains if they sold that property on a difference between $50,000 cost basis and $1 million. But think about how powerful that is. Think about the magnitude. Reduce the state tax exemption to $3.5 million. Remember what I was saying before? The state tax exemption is $11 million of $11 million right now. To go back to $3.5 million, we are now back to the drawing board of doing that sophisticated estate planning. This means estates over that value would be taxed. Obviously, this is all a proposal, but it could be helpful information as you plan future tax years depending upon the election outcome. In summary, folks, here are some items that you should review prior to tax time. What is your tax bracket? Do you take the standard or the itemized deduction? For timing purposes, we have to figure that out, right? And again, it has to be done before the year end. So give us a call. If we haven't done this for you yet, please give us a call. We'll be happy to do it. Capital gains and loss harvesting on non-qualified investments. Retirement plan contributions, educational planning opportunities, charitable gift planning, estate planning opportunities. It is also helpful to think about tax planning for any major financial or life events next year or in the future, as well as tax planning for any other personal situational concerns. Our tax report for year-end tax planning is out now. As we said when we started, a proactive approach to your tax planning instead of a reactive approach could produce better results. Of course, if you know anyone who could benefit from our report or this workshop or any information that we provide, please pass it along and let us know. It would be our pleasure to help one of your family members or friends. That's how we grow a business over time. And we are so happy to be here with you today. We enjoy helping others and always consider introduction to others to be the highest compliment that we can receive. So thank you for your time today. Remember, your health and your well-being is our highest priority. Our goal is to help you, and we appreciate the opportunity to assist you with your financial needs. So please call our offices whenever you need to, and we'll be happy to assist and answer any questions that you may have.